Nothing strikes fear into the heart of a Big Four banker more than the words tax debt. And yet, many business owners, as well as their accountants, view a tax liability as normal, especially in uncertain or challenging economic times. That is, until they apply to a Big Four bank for a loan and potentially get their application declined. So today, we'll be going through the myth, tax debts don't impact my loan application, and looking closely at how a tax liability changes your chances of loan approval. My name is Tommy Lim, and welcome to another Finance Mythbusters. First, what is a tax debt? A tax debt is a liability owed to the Australian Tax Office for any income tax, PAYG tax withholding, or GST payable arising from your business activity statement. It's normal for a tax debt to arise when you lodge your compliance paperwork or reporting to the ATO. And there are no issues if you pay your tax liabilities immediately or within a reasonable time. It's when these tax debts linger or are put on ATO repayment plans, or even worse, not paid at all, do they cause a concern for a mainstream bank. An ATO repayment plan is an arrangement to pay back your tax debt over a period of time set up by your accountant and agreed to with the ATO. Like any other debt outstanding, a repayment plan has a monthly installment and an interest rate applied to the outstanding amount. So, how does a bank know about a tax debt in the first place? The bank finds out about a tax debt due to the information collected during the credit approval process. This is especially so for a commercial or business loan application. The two main documents that reveal a tax debt are firstly your income tax account, which shows your income tax payable for either yourself or your business. And secondly, your integrated client account, which shows your lodgement history as well as the tax payable for taxes other than your income tax, such as GST and PAYG withholding tax. The bank may also see regular payments to the ATO via your bank transaction history, prompting further questions. In addition to this, in late 2019, the ATO obtained powers to report any tax debts to credit reporting agencies, thereby giving the ATO the ability to openly disclose any tax liabilities in your credit report. While this has not happened yet at the time of recording this video, the ATO has begun issuing letters to unresponsive taxpayers, warning that they will start marking their credit file if they do not begin to cooperate. Now, knowing tax debts exist, what does this mean for your loan application? I'll start by saying that most mainstream bankers and credit officers hate tax debts. The reason for this is that it raises questions about your character in relation to your readiness and willingness to repay a loan. While there might be good personal or business reasons for having an ATO debt, such as managing your cash flow during uncertain times, or using your funds for an investment opportunity that is simply too good to miss out on, bankers tell me all the time that if a client can't pay their taxes, what makes you think they're going to repay their loan? I know this is a bit judgmental, but this is a common response I hear all the time from the bank when encountering ATO debt. In extreme cases, the ATO even has powers to freeze your bank account to make sure the tax office and any vulnerable parties, such as employees, are repaid first ahead of any other creditors. These garnishing powers make a bank's position less secure and lowers the likelihood of being repaid if something goes wrong with the loan. It's for these reasons that a bank is more willing to decline a loan application than take on a borrower with an outstanding tax debt. So, knowing a tax debt is viewed negatively, what can you do about it? I recommend 3 courses of action. If you have the funds available, the first option is to clear the ATO debt before you even submit the loan application. Alternatively, you can request to have the tax debt cleared as a condition of formal loan approval. Most clients that we help advise us that if the bank is willing to approve their loan, they're happy to cooperate and pay out the tax debt in full, a scenario where all parties win. A second course of action is to explain the nature of the tax debt, often with the support of an accountant's letter, and request that the repayments associated with the tax liability are factored into loan servicing. We find this to be a less effective and more uncertain approach, as it lowers a client's borrowing capacity to make the loan amount less meaningful, and in an extreme case, the deal totally unworkable. This is due to the short-term nature of ATO repayment plans, which are typically 12 months, which results in larger loan repayments and places a drag on a business's cash flows for loan servicing. The third course of action is to seek a loan from a lender that is more comfortable with tax debts. These are typically non-bank lenders who are still willing to approve a loan as long as they understand that the tax issues are not ongoing and that there is a pathway for the tax debt to be fully repaid. We hope this breaks open the myth, tax debts don't impact my loan application. As this is a more sensitive and technical topic, we strongly recommend you seek the advice from your accountant before taking any courses of action in relation to your tax debts. As always, if you have any questions or feedback, please feel free to drop them in the comments below or email or message me directly. And if you found this information useful, please like and share this video, as well as follow SF Capital on YouTube and social media. This concludes our Finance Mythbusters series, but I promise you, we have plenty of exciting content to come. It's been an absolute pleasure educating you on the challenges that business owners face when getting a loan. Thank you for watching, and stay tuned for more valuable education and advice from myself and the SF Capital team in the future.